Welcome to a quick episode of Badass Banker. There's a lot of talk about AI bubbles. So I did a little homework and I put together some information from a variety of sources into Notebook LLM. This is a new tool from Google that's pretty cool. So take a look and let me know what you think.
The stock market is hitting all-time highs, right? And it seems like everywhere you turn, people are talking about one thing: artificial intelligence. We're in the middle of this massive surge in AI stocks that's creating literally trillions in new wealth. But as you can imagine, this has kicked off a huge debate. Are we watching a real technological revolution unfold, or are we all just riding a dangerous speculative bubble that's about to pop? Okay, to really get a sense of just how huge this is, I want you to lock in on one number: 80%. That's the percentage of all the gains in the US stock market this year that have come from AI companies. You heard that right. If you took AI out of the picture, the market would basically be flat. That's just wild. It shows you the power of this one single trend. And that really brings us to the big question we're going to tackle here. Is this whole AI boom built on a solid foundation of real, profitable technology? Or is it just speculative hype, doomed to crash and burn like so many bubbles before it? Let's break down the evidence for both sides. All right, first things first. Let's dig into the strongest arguments for why we might just be in a bubble. Analysts are pointing to some very specific and frankly kind of concerning behaviors that look eerily similar to market manias we've seen in the past. Okay, so one of the biggest red flags for the bubble watchers is this thing called circular financing. Let me break it down for you. Imagine a giant tech company invests, say, $1 billion in a little AI startup. Then, that startup turns right around and uses that exact same $1 billion to buy products from the big company that just invested in them. So on the books, it looks like sales are exploding. But in reality, it's just the same cash going around and around in a circle. And look, this isn't just some abstract theory. Ben Inker over at the investment firm GMO draws a direct and pretty chilling parallel. He says this kind of financing is exactly what was happening with companies like Cisco back during the dot-com bust. And if you were around for that crash, you know that comparing anything to the year 2000, well, that's a huge warning sign.
But it's not just the circular financing, right? There are all these other little things that make you go, I mean, we're seeing what some experts are flat out calling ludicrous price moves, like a stock jumping 43% in just 3 days. At the same time, you've got insiders, guys like Warren Buffett, selling off billions in stock. When the legends start selling, you gotta pay attention. Not to mention, some really key leaders in tech are deciding now's a good time to step down. It all just adds to this feeling that maybe, just maybe, we're at a tipping point.
And if you want to see just how crazy concentrated this market has gotten, just look at this. The top 10 stocks in the US now make up a full quarter of the value of the entire global stock market. Let that sink in for a second. A handful of companies hold that much of the world's wealth. That's a lot of eggs in one basket. It creates a pretty fragile system.
Okay, so that's a pretty scary, compelling case for a bubble, right? But hold on. Now we're going to flip the script. A lot of very smart people are arguing that this time, things are fundamentally different, and that comparing today to the dot-com bust is just the wrong move. Here's why.
Jamie Dimon, the CEO of JP Morgan Chase, put in a way that I think makes a lot of sense. He says, look, AI is real. He thinks it's as big a deal as the invention of the automobile. But, and this is a huge but, he's warning us that just because the tech is a game changer, it doesn't mean every company jumping on the bandwagon is a sure bet. And this right here is probably the strongest part of the "it's different this time" argument. Just look at the valuations. Back in the dot-com bubble, tech stocks were trading at a mind-boggling 52 times what they hope to earn in the future. Today, the big AI-related stocks are trading at a much more reasonable 27 times. And here's the kicker. Back then, a lot of those companies were making $0. Zilch. Today, these AI giants are raking in massive real-world profits.
And hey, this isn't just one guy's opinion. You've got major investment banks like Goldman Sachs saying basically the same thing. They're saying, yeah, things look a little pricey, a little stretched, but we're not in that red alert, extreme danger zone we saw right before past bubbles burst. The foundation, they argue, is just a lot stronger this time around.
All right, so this whole AI boom isn't just happening in its own little world. It's having this profound impact on the entire US economy, and it's creating this really fascinating and maybe a little worrying situation that experts are calling a two-speed economy.
So Ben Inker, the same guy who warned us about circular financing, he describes it like this. You've got the AI sector in the fast lane just flooring it. And then you have pretty much the rest of the economy just kind of sputtering along, pretty close to stall speed, as he puts it. And wow, this chart right here really shows you what that looks like in practice. A staggering 92% of all economic growth in the US this year came from this AI-driven tech investment. So the takeaway here is pretty stark, right? Our whole economy is basically riding on the back of this one sector. If that AI boom ever slows down, the whole economy could feel it.
Okay, but here's the thing. While everyone and their brother is obsessed with AI, some really smart investors are looking in other places. They're finding what they see as great deals in places like Europe and Japan, where they say valuations are really, really cheap compared to the US. Even right here in the States, you have sectors like banking that are doing really well, and it's got nothing to do with AI. It's just a good reminder that there's a whole world out there beyond the hype.
So, okay, we've got this really complicated picture. Part of it feels like a real revolution. Part of it feels like a potential bubble. So what do? How are experts suggesting we think about all this? It's not really about predicting the future. It's more about being prepared for whatever comes next.
So what's the general playbook here from the experts? Well, first, they say it might be time to rethink what diversification really means. An S&P 500 fund isn't as spread out as it used to be. It's a huge bet on big tech now. That's why lots of folks are looking at that international exposure we just talked about. But probably the biggest rule of all, don't even try to time the market. Seriously, history has shown again and again that trying to pick the exact top or the exact bottom is a losing game.
Okay, now listen up, because if you only take one single thing away from our whole conversation today, I want it to be this. For anybody investing for the long term, we're talking 5 years or more, studies show something incredible. Even if you have the absolute worst luck in the world and invest at the very peak of the market right before a downturn, it makes almost no difference to your final returns. Why? Because over the long haul, the market's trajectory is up. What feels like a terrifyingly high peak today could just look like a little blip on the radar 10 years from now. And so, at the end of the day, here's where we land. The AI revolution is real. It's happening. That's not really up for debate anymore. The real question is, are we building that future on solid ground, or are we just building a bubble that's destined to pop?